All right, folks, it is Sunday again. This is volume number 6 of the Market Pulse newsletter. And so, for our random chart of the week, we're going to look at Wells Fargo. And when we're talking about price energy, we can look for certain clues. And so, in this particular chart, we've got an example of bullish gaps. I'm not sure that we'd quite call those runaway gaps, but they are suggestive of that idea that price is gapping higher um, as it moves along with no intervening corrections. So the idea that price is running away to the upside. And so let's zoom out a little bit here. And so we got the bullish gaps, and that has taken price back above the 200-day moving average. And so we've got the 50-day and the 200-day. Um, and so in Andrew's pitchfork terms, the fact that price has popped back above the median line of our modified shift pitchfork, our next price target becomes the next median line, which in this case is up here around 33. And coincidentally, if that happened by the end of the year, there it is on the calendar, 18 or 22 December, somewhere in there. So that's a possibility in Wells Fargo. And another interesting aspect of this chart, when we talk about placing our entry stops for our trades, ideally we'd like to place a close stop underneath some significant market structure. And so in this case, we've got this gap and the 200-day moving average. And so I would suggest that that's a significant support level, and that placing a stop somewhere below that level would be appropriate in this case with 33 as a price target. And of course, now the next question becomes, can we get our ratio, risk to reward ratio, into our to meet our particular parameters in order to take this trade. And so anyway, just thought that was an interesting setup in Wells Fargo. So let's continue on with the charts. And so this is S&P 500. We've got price pushing up against the top of the trading range, which is coincident with the median line of this blue Andrews pitchfork. And so that action is suggestive to me that price wants to push higher here. Um, MACD is overbought, but overbought can become more overbought. If we go relative to, back here in late August, early September, MACD was more overbought than it is currently. And so MACD is not a bounded indicator, but that's prior highs can act as resistance levels in MACD. So, but anyway, if price wants to break out here, it's got a little bit of room to run before it runs into resistance. There, plenty of energy. Let's continue. Very similar in the Dow. Prices up, top of the trading range, coincident with a median line. We could pop higher. MACD is again overbought, but not as overbought as it was back in what was this, June in this case. So, and high energy if price wants to go higher. But again, all of the equity markets are very overbought. In this case, we look at price relative to the 50-day moving average or the 200-day moving average. And so price is very overbought relative to both of those moving averages. And then the 50-day moving average relative to the 200-day moving average. That's also extremely overbought. So equity markets are very overbought. Now Nasdaq was, back here. We talked about having several layers of resistance as price kind of chopped through this stuff. Well, it looks like at the end of last week, the Nasdaq has pressed higher, gotten out of all this noise, and potentially could be about to break higher. Um, and because Nasdaq has been waffling sideways, price is not as overbought as it is in S&P 500 and Dow. So we might see we might see relative strength in Nasdaq, while the Dow and SPX deal with resistance. U.S. dollar just, it continues to be weak. Prices bumping lower along the median line of this shift pitchfork. Last week we got a drop below this horizontal support level that, it had provided support, 1, 2, 3, 4 times. And so that's a non-trivial support level. And so having it break is suggestive of significant weakness. Let me reset this chart. This is the weekly time frame in gold because I wanted to focus on a big picture here and show that relative to the peak at the end of the 2001 rally, so this is 2011, early 2012, we got this action in gold where we peaked, we pulled back, and then tested this resistance at this point, tested this resistance level 3 times, and then got, of course, the long, grueling bear market. And just now in the last since this bottom in 18, we've gotten back into rally mode. But what is significant is that we broke through this resistance level, and the correction that's going on 4 months old now has taken us back to that breakout level. And so that's common behavior in the markets, where we'll get a breakout and then price pulls back and tests the breakout level before moving higher. And coincidentally, that level happens to occur along the 40-week moving average in this case. And so again, that's a good place for price to move higher from if it wants to. And of course, we need to keep in mind that price spikes below that level are not uncommon. We can see it right there. And so, we might get another price spike lower. And if we continue to look at silver, so one of my thoughts in silver, well, one, it's relatively stronger than gold. Here's price at the close Friday, and it's roughly $2, 10% approximately above the 200-day moving average. And so relative to gold, which pulled all the way back to this is the 40-week, but same as the 200-day moving average, silver remains above its 200-day moving average. So that suggests to me one of two things. One, this relative strength in silver could be suggesting that the correction is over or nearly over in the precious metals markets. And of course, to cover both of my cover all my bases, it could also be suggesting that we have at least one more price whack um, to experience before a tradable bottom in this market occurs, in the precious metal sector occurs. Um, so that's silver. The mining stocks, and of course I use GDXJ as my proxy for the mining stocks, have pulled all the way back to their 200-day moving average now, which is coincident or nearly coincident with the bottom of this pink downward sloping price channel. And so that's our 4 month or almost 4 month correction in the mining stocks. And so again, potentially reaching a bottoming point, excuse me, around the 200-day moving average. MACD might be hinting at some bottoming action, same in stochastics. Of course, price is oversold at this point, um, so reversion to the mean could well, no, it's at the mean really. Relative to the 200-day moving average, it's at the mean. So let's continue. We got Brent. So I was expecting to see more resistance here at the $46. It's about 46.30 level in Brent crude, but price sliced right through it. Waffled sideways a little bit last week along this median line extension of this shift pitchfork. Appears with Friday's action that price wants to head higher, and we got a big round number with $50, and the next median line extension just above $50. And so if you're trading oil, you might want to be looking at something with a $50 target this week. Interest rates as represented by the 10-year note waffled mostly sideways last week along the 20-day moving average. And so we are at 13 minutes, folks. I am going to wrap it up. Have a fantastic week.